Well, hi, everyone. Thank you very much for joining us today for this webinar. We're really excited to be here. We're going to be talking about how to improve your revenue stability and how that can increase your firm's value. So we're really excited to share some really cool stuff with you today. Well, a good place to kick things off is with the question of, why is revenue stability so important? We all know that revenue is important for any business, of course, and solid, strong revenue, but stable revenue makes a big difference for any business. If you think about planning for business investment, right? Or managing your business on an ongoing basis, having confidence in the future of your revenue streams is really important. It's also important for M&A transactions, isn't it, Carla?
It is, whether you're a buyer or a seller, having that revenue stream that's more stable, less volatile is a big factor in whether you're going to be successful in M&A.
Absolutely. And then supporting that M&A oftentimes is financing, right? If you're going to get a business loan, a commercial loan to acquire another business, or somebody is going to get a loan to acquire your business, the stability of the revenue stream is really important for whether that bank is going to feel confident at a certain lending level.
Absolutely is. And that kind of brings us full circle when we think about the valuation, of your own business as a buyer, or just, valuation in general. Let's be honest, a lot of our revenue streams sometimes are out of our control, right? So if you have a portion of your revenue stream that is more reliable, more stable, more predictable, well, guess what? That makes your valuation a little bit better. It makes your firm a little bit more stable and stronger.
So now let's work through each of those reasons why revenue stability is important, kind of in reverse order a little bit, because most folks are attending this webinar with an interest on the valuation piece, right? They really want to understand, how does revenue stability affect their valuation? So when you're working with clients, Carla, how do you see revenue stability working its way into the valuation equation?
Yeah, well, let's get down to the core of it. Revenue is the key driver of the cash flow that your business generates. And that cash flow is kind of the core component of most of the valuation calculations that we use in the process of valuing a business. That stable revenue stream really should produce a stable cash flow when you get down to it at the end of the day. It's kind of logical, but it sometimes gets lost in translation. And that stable stream of cash flows really should present a lower discount rate than a stream that's got higher volatility when we think about using the discounted cash flow model for that primary methodology that's used.
It's interesting. We have talked about this a lot. Anybody who's attended the prior webinars that we've done, or read any of the blog posts that you've written, or the podcast that I've hosted, we talk a lot about cash flow being the thing that is what's being valued in your business, right? Like, obviously there's some other things, but if somebody were going to buy your business, acquire your business, they're not acquiring a factory, right? They're not acquiring patents and other technology stuff. They're acquiring a stream of cash flows, like relationships from clients that produce cash flows. So having a stable stream of cash flows, which is a derivative of revenue, is really, really important for that valuation. Continuing along that line, valuation is a big part of M&A activity, right? If you're going to buy or sell a business, at some point in time, valuation is going to come up, right? But also, if I'm thinking about buying or selling a business, right, the stability of the revenue in that business is going to come into play at some point in time. So how do you see stability impacting the deals that you're often involved with, right? You're often there coaching and working with advisors as they're thinking about selling their business or buying another advisor's business. How do you see this coming into play?
Yeah, well, revenue stability is that risk metric because revenue ultimately leads to the cash flow. So when you have cash flow that becomes more questionable or less reliable because of the source and the stability of that revenue, it has a big impact, right? Not only that, but for buyers and sellers and lenders who finance the deals, they should take a really hard look at that revenue stability of of that business, not only of yours as the buyer, but also, of course, the seller's book to assess the risk profile of the deal.
And as we teed up earlier, a few slides before this, the M&A activity is almost certainly going to have a financing component to it as well, right? And so your lender, whether it's you or as a buyer borrowing money to acquire a business, or your buyer, if you're a seller, they're going to have to borrow money. And that bank, that lender is going to be looking at the stability of the business, because banks are not in the business of losing money, right? They really want to make sure that you have the money to pay them back and pay them back on time. So making sure things are stable is going to be really, really important there. So now for my favorite topic, I think, and it's stable revenue makes for a stable business. I mean, if you think about running a business, knowing what your revenue is going to look like, or relatively close, in the years to come, really gives you a lot of confidence and flexibility in that business, right? Like, so for instance, I can have confidence of investment for my business. I know that I can invest in that new technology or expand to another office. I'm in Austin, Texas. If I wanted to open an office in Dallas to serve clients there, or acquire a business in Dallas, I can do that with more confidence because I know I have some predictability and stability in my revenue stream. I'm not worried about next quarter revenue might drop by 30%, right? I know that's an extreme example, but it also gives you some other, confidence in just basic business planning, right? Like less freaking out about meeting my quarter or my monthly, right, stuff. I mean, one of the things, lastly, on this one is, we don't talk about this enough, but this is a lifestyle business for many, many advisors. And there is no shame in that. Not every advisor is looking to, add another advisor to every year and continue to grow at breakneck pace and get their business to multi-billion-dollar AUM. Many advisors get to a point where they're making $500,000 a year and they're like, this is a nice lifestyle, right? It can be very disruptive to one's lifestyle to have your revenue go from $500,000 to $350,000 the next year, and then back up to $475,000 and then back down to $400,000, right? That's not a good lifestyle business. That is an anxiety business. So stability of revenue makes for a much more stable business. So keep an eye on it. Now, let's dive into the drivers of revenue stability. We've thoroughly hammered in to the ground, the point that it's important. So let's go for it. Carla, you brought this up in prep for the show. You were talking about how important an advisor's or firm's product and service mix is to revenue stability. And I wonder if you could kind of walk us through that a little bit. What are you looking for if you're saying that this business is more stable than another, and when it comes to product and service mix?
Yeah, so let's touch on the kind of unique thing about our industry is that revenue is largely unpredictable. It depends upon how the market performs. So sometimes it becomes really important to look at the underlying product mix that an advisor is using. Obviously fee-based versus more commission type products, and even commission when we think about like annuities. Are you taking a large commission up front, or are you creating a trail for yourself? That becomes huge when we think about the cash flow that hits the bottom line and how stable that cash flow is going to be going forward. We also have the unique nuance in this space with some kind of one-off or supplementary revenue. A lot of advisors are selling insurance. A lot of advisors are doing tax prep. We've got financial planning fees, and something that a lot of advisors may not always realize. A lot of advisors are doing financial planning. Not all of them are charging a separate fee for it. And when I can tell an advisor, hey, like if you do charge a financial planning fee, let's say you charge $10,000 a year for a financial plan. Well, you know that $10,000 is going to come in, the market can tank, and you still have a really, really stable and reliable revenue stream that's coming in for your business.
I think that's a really important point that you just made. Some of these, what we consider one-time fee revenue streams, so whether it's a commission revenue or a financial planning fee or something of that nature, estate planning fee, they can be recurring revenue if you've got a really strong process in place to make sure. So if I looked at your business and you do financial planning fees as an example, you charge all your clients separate and discrete financial planning fees, and maybe you do some AUM fees as well. But if you're like hitting it every year, like, listen, for the last 10 years, financial planning fees are really consistent in this business. You want to know why they're consistent? Is here's the process that we use. And whether it's for bringing on new clients or our existing clients have been with us for this long and they pay this fee every year, rain or shine, they can count on it. That's less scary to me, right? But if all of a sudden, like, hey, we had a banner year, we did, 100 financial plans, we made a whole bunch of money, and the next year we only did 50 financial plans, less stable and more scary if I'm thinking about acquiring a business. And it's absolutely going to, I think, affect that valuation, right? Now let's dive into portfolio management. This is one of those ones that you brought up again in prep, Carla, and we've actually been banging this drum at Truelytics for as long as I've been involved with the team. And it's that whole like model portfolios versus manual portfolios. And I hadn't given that much thought until we started talking about it in those early days. And I wonder if you might be able to share like why that's so important and the type of impact it can have when we think about the stability of one's revenue stream.
Yeah, well, think about it this way. The stability of the business and the revenue and what have you that kind of are generated from that, you want to make people replaceable. I mean, we don't want to hear that about ourselves, right? So when you think about using model portfolios versus like manually picking things yourself, oftentimes we see these firms that they're one, maybe two owners, single advisor. If the portfolios are relying on that one individual, well, you've just upped your risk factor tremendously. So yeah, a lot of people don't really like make that connection until they start thinking about it. But yeah, model portfolios are going to be much more predictable from an ongoing management perspective than if one person's just putting portfolios together in the office. What if that person doesn't show up one day? What does that mean to the business and the impact that it's going to have? Obviously, there's less variability and likely less room for human error too if you're using model portfolios.
Yeah, that one's one that really hits home for me is like, there's so much room for error if I'm managing different portfolios for every single client. And yes, there's always going to be some variability in your client mix. Some of them might have, company stock and the like. But knowing that when I make a change to the model portfolio, it changes all the clients' portfolios the same way is a sleep at night factor, right? Like there's a stability there. And yes, if the market goes down a little bit and it negatively impacts revenue, it does so consistently, not wildly.
Well, yeah. And don't forget that allows you to create scale within your business too, Yeah. And let's think about the value in being able to achieve scale through the use of model portfolios is huge.
Yeah, absolutely. It's part of that system, right? And that leads us into our next topic of investment process. And model portfolios, they're one component of an investment process. So you brought up some really interesting stuff, and I think you just started to poke at it a little bit in that previous slide, that the people who are doing this is a really important component to stability. Can you elaborate on that a little bit more?
Yeah, for sure. So let's go back to that. Hey, I'm irreplaceable. Nobody can do what I do. I hear that a lot from owners as well. Yeah, that's great. Actually, really, it's not, because what if you don't show up one day? When your investment process, let's think of the options. You can have one person in-house doing it, you can have a team in-house doing it, or you can outsource it. When you think about how that business is being run from a day-to-day operations standpoint, what if that one person doesn't show up? What if that person is the one that's managing the investment process? Well, your business is left pretty vulnerable. You're at risk. It's negated a little bit, obviously, when there's a team inside the firm that's doing it. And that's less of a concern if somebody doesn't show up one day. But what if you lose one of those key employees to a competitor, or they retire, or what have you? And then let's take that even a step further. And what if you just outsource all of it? You don't even have to worry about it. People are interchangeable within your business, and it does lend to a degree of stability that a lot of people tend to overlook.
Yeah. And it also gives the business a resilience, like you were saying, right? So, stability in the revenue process is really important, but it gives you a little bit of resiliency. Like I said, in the event of an emergency, right? We're in the middle of a pandemic. It is likely and probable that someone on your team is going to experience an illness, either theirs or a family member, right? So there's going to be some concern there. And I also think, kind of going back to how this feeds into valuation and the potential of an M&A process or succession, it's much easier to hand off a business that has, as you mentioned, an outsourced investment process involved, right? A team involved, or it's a full team, right? Versus it's just being one individual. And what if that individual leaves and doesn't like the new acquiring advisor, their vision or whatever, like now that business is just hosed, right? Because like, wait a minute, I bought this thing that works and now it doesn't work anymore, right? It's all busted because this one guy left, right? I need to go find another guy who can do what that guy did. And we've all worked in places, by the way, that has had that person, right? They seem to have too much power, disproportionate power to their role because of like they're the one who's built all the complex spreadsheets. Nobody knows how to do it the way they do it. Nobody knows where the files are. Anyways, I think this is just such a smart thing to key in on. The investment process makes a big, big impact. Now, lastly here, and we talked about this in our last webinar, I believe, it's client roster mix, right? That just makes a huge difference. As I think about it right now, specifically as we're moving along here in the 2020s, and we saw the stat that the average age of a financial advisor is creeping up like 62-ish. There's been a few studies that predict somewhere in the neighborhood of 40% of financial advisors are going to exit the business in the next decade or so. But then you see other things in that, kind of like that little bullseye target thing, that the average age of your clients are somewhere in the neighborhood of 10 years near your age if you're an advisor. So if you're a 40-year-old advisor, you know, all the way down to 30 maybe, all the way up to 50 for the most part. But as you creep up in age, some of your clients are starting to get old. And there's a lot of risk in that client roster. If you're a 65-year-old advisor, chances are you got some 75-year-old clients or maybe even older. And so what happens, right? Declining revenue base, potentially. Revenue base that's more susceptible to those clients leaving because if they pass away or they get old and they start experiencing maybe some things that come with aging, like dementia, and their heirs come in and take over the accounts and they just move. So client roster, big, big risk. And the other thing we talked about, Carla, and you and I had some fun with this one, is niche risk. This has come in a lot. Again, thinking about the pandemic, if you have a client roster that's restaurateurs or some people in the entertainment industry, live entertainment industry, like sports or movie theaters or other regular in-person theaters, concerts, there's a lot more risk in your revenue stream than there might have been 2 years ago, right? I mean, because, oh my gosh, what happens if that restaurant goes under? That client's assets probably going to decline a little bit. They might have to eat into some of those assets to survive, or they might not be willing to pay that financial planning fee that you mentioned every year because they're like, I don't have the money. Anyway, client roster makes a really big impact.
Think about this too, Mike. So if you're 65 and your clients are around the same age as you got to think too, are those clients maybe in distribution phase? Is there money walking out the door through distributions, more revenue or assets going out through distributions? And think about too, when you hit that point in your career where you're 65, you're probably on cruise control. You're probably not going out and doing those same rainmaking skills you were when you first got into the business. So the question is, hey, what am I sitting on here? Am I sitting on a depreciating asset where I have more money going out through distributions than new assets that are coming in? Yeah, you're right. It does make a huge impact on the revenue and the stability of that revenue.
Absolutely. That's fantastic. Fantastic thought process there. Like, we all enter certain phases, right? You get in that consumption phase, and it happens. It happens to everybody. And even if they're very affluent clients with tens of millions of dollars of assets at management with your firm, chances are they're going to start consuming those assets, right? They're starting to look at life and they're getting a little YOLO, doing some stuff with that money, giving some money away to the grandkids, around the world trips, all that kind of good jazz. All right, now let's talk about how advisors on this webinar can use Truelytics to get a better hold on their revenue stability. So you understand it because Truelytics has unveiled a new revenue stability scorecard that could really help you analyze where you stand and take the appropriate action that makes sure your business is maximizing its value based on revenue stability metrics.
Yeah, so it's important to note for those that are familiar with our platform, we did change market stability to revenue stability. So if you recall, market stability just had the underlying product breakdown and the revenue tied to those products. So we have expanded those categories. We've now doubled them. I think there's like 18 or so. And we've added factors around the revenue stability to the scorecard. We moved over the recurring percentage. Of course, that's a huge one. How much is recurring of the revenue? Whether you're using model portfolios or not, those model portfolios, who's managing it? Is it one person? Is it a team? Is it outsourced? And we've also added in some questions around whether you're using an investment committee and how frequently you're monitoring investment results and client activities within those accounts. So we've expanded the scorecard quite a bit to give you much more granular information about the particular stability of your revenue streams.
Really, really smart. I love this new innovation because it really feels much more actionable to me. You mentioned it's more granular. And anytime I get a little more detail about my business and I can not only look at it and analyze it compared to how I was doing in the past, but I can also look at it and like, how do I look compared to my peers, right? To other businesses that are of similar size. Because again, when we bring this all home to valuation and how you look as an M&A partner potentially, or how you look to a lender, they are going to look at how you compare to others who look similar to you, right? Because if I'm an M&A partner, as an example, I'm considering buying a business, I'm not just looking at one option. I'm going out and shopping. I'm going to look for other advisors who are selling the business and kind of evaluate them against yours. I've looked at others that look like yours. This one's a little more stable, right? So really important that you have a handle on it. And this revenue stability scorecard can be of tremendous help. Before we get to Q&A here, I do want to encourage everybody to swing by truelytics.com and make sure you kind of take a little lay of the land, explore some things. And if you have some more in-depth questions and you'd like to see a demo of True Performance and get a feel for that revenue stability scorecard more firsthand, just use that little contact form there and we will make sure you get that taken care of. All right, let's get to some Q&As. Send your questions at us. Let's go.